Hello, everyone. Today on the final bar here on Friday, July 29th, we will wrap this week. We'll focus on this resilient upwards thrust that started earlier in the week, treading water going into the Fed meeting, but the strength in tech and communications earnings overwhelming any negativity that we've seen. Belief in the Fed, belief in this bullish trend, and overall pushing higher, nearing that 4150 to 4200 level. So what is next for stocks, ladies and gentlemen? This is the final bar. Hello, everyone. Welcome to this Friday edition of the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and very warm Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the Technical Analysis Toolkit. And I'll tell you what, the toolkit is being tested in a big way. And what I mean by that is technical analysis helps you understand what phase of the market we are in. Are we in a clear uptrend? Are we in a maybe a distribution pattern, a basing pattern rolling over? Are we in a downtrend? Are we in an accumulation pattern, sort of the pattern rolling over? This goes back to, I think, Stan Weinstein's phased approach to looking at different things. And a number of other strategists have had similar methodologies to try to describe different market phases. When we change from one phase to another, what I would call a change of character, can be very difficult to detect in the heat of the moment. It's always crystal clear down the road, right? The reality always looks crystal clear in the rearview mirror is what I always say, but in the heat of the moment, it's very difficult to detect. I will tell you, when we look at signs of breadth, when we look at signs of trend, when we look at signs of momentum, you find the strength. You really can measure the strength coming off of the lows about 4 to 6 weeks ago. Let's look at some of those charts through the course of this show and see what the Friday close, resilient to the upside, really tells us about the bigger picture. Before we get there, I'm so thankful for the guests that we've had on this show. I had a really good discussion with Miss Schneider yesterday, which I'd certainly encourage you to check out if you missed. Elsewhere on StockCharts TV coming up next week. On this show, on the final bar, two guests to mention to you. On Tuesday the 2nd, we have Jonathan Krinsky from Baycrest Partners. On Wednesday, August 3rd, Louis Yanis from WealthNet Investments in Colorado. Also, 3 special events all coming up next week to let you know about. On the 3rd, we have Charting the Second Half. That is our mid-year market outlook. I'm participating along with 3 guest speakers. We each were asked a set of questions, sort of looking forward through the remainder of 2022. I think you're going to be fascinated to hear what our group of strategists laid out in terms of a potential roadmap for the next 4 to 6 months, really. So I'd encourage you to check that out. It's coming up on the 3rd. On Monday, we have Larry Williams giving his latest market outlook special. As a preview, it's pretty bullish. So you can see what he says at 9 a.m. Eastern on Monday. That's coming up on StockCharts TV. Also, our latest episode of The Pitch is going to air next week as well. That is where 3 guest experts each pitch you 5 stock or ETF ideas. So we have a lot of force we're bringing to bear on this market. We will navigate these things together. And we're glad that you're part of or joining StockCharts TV as we navigate these uncertain times. Let's continue on with today's show with our Wrap the Week segment. Let's focus on the week that has come, start to look forward to the week going forward. Did want to start with a poll, though. I asked you recently which of the generals performs best over the next 3 months. General Electric, General Motors, General Mills, Dollar General. This is a question that was inspired by my time at Fidelity in the Fidelity chart room years and years ago when it was all done by paper. There was a chart called the Generals. Some of those names like GM and GE and others were included in this sort of index of big industrial conglomerates. And the idea was follow the generals, right? The generals are giving you the trend. Out of those 4, which is the most attractive? Let me go to the charts here because I actually created a chart list with these 4 stocks on here, which we can kind of break them down here pretty quickly. Let's start with just a candle glance of the 4 of them. So we have Dollar General, General Electric, General Mills, General Motors from left to right. Most of you said, is about 54% of you answered Dollar General. And I'm looking at that first chart. Can't say I disagree with that assessment. And I tell you what, if you're bullish, I mean, part of this is sort of a market call, right? If you're bullish on stocks over the next 3 months and you think that we're recovering from here, Dollar General is not a bad bet. Yesterday, I was talking with Ms. Schneider about what she calls granny retail. We looked at the XRT, which is a retail ETF. For the market to really recover, you really need to see the participation in retail, right? And sort of a traditional offensive part of the market. Dollar General could certainly be part of that. General Electric, while it's bounced off of the lows, it's hard to get really excited about that chart at the moment. I'm going to come back to General Mills because General Motors, I think, similar to GE, those are two sort of big industrial automotive types of names. I still think while they have bounced, I don't think that's where you're going to see leadership. Here is my non-consensus vote then. I would probably pick General Mills. General Mills was second in the voting, 23%. Here's the reason, right? We're at the end of July, which means August, September, October. That means on Halloween, which of these stocks has done the best? I am still feeling like we get a retest of the lows. I still feel like there's going to be a defensive feel to this tape again before 2022 is over. And if the timing is right, GIS could actually allow you to navigate through that pretty well. I like the fact that it's broken out, pulled back to a previous breakout level. And if that holds, it's actually a pretty interesting timing right now on GIS. That's probably what I would vote, but Dollar General would be second for sure. Let's continue on our Wrap the Week segment and look at the Wrap the Week chart. So what we like to do is start with the week that has happened. It's this one right here. This is looking at the last 5 trading days. We start the clock on last Friday's close. Let's talk about what has happened, and then we'll start to look forward and talk about where things may be headed next. So Bitcoin having the best week out of all of these, up 5.2%. After that, it was crude oil using the USO up 4.7%. In pink, we have the NASDAQ 100 up 4.5%. Small caps and large caps basically netting out to the same gain, about 4.3% for the SPY and also the IWM, which is the Russell 2000 ETF. Everything else here underperformed the S&P this week. Gold was still up 2.1%. Chart of gold is an interesting one. The strong dollar has made it so tough for gold to do well, but dollar pulls back more than it has already. That was part of my conversation with Dale Pinkert on Wednesday's show. If you missed that one, that was a good one as well. Emerging markets here up 1.4%. Then we have two that weakened through the course of the week. The dollar index down 0.7%. It's actually using the UUP, which is a dollar ETF. And then the worst performer bonds, right, down 0.9%. It's very much a stocks over bonds type of week, very much a risk on over risk off. The fact that Bitcoin's up 5% and bonds are down 1%, weaker dollar, that is giving plenty of space for these risk assets, along with gold and others, to have a pretty decent week. Let's look quickly at what happened today. It was more of the same. If you think about the last couple days, start the clock at the Fed announcement and the Fed press conference Wednesday at 2:30 Eastern to where we're at now. It's just been a nice sort of risk-on feel to the tape. Tech earnings, things like Apple and Amazon yesterday, certainly giving more and more fuel to that upward trend. Amazon, the biggest gainer in the S&P, up over 10%. And when Apple is up 10%, Amazon's up 10%, Apple's up 4% or something like that. There's no way the indexes are doing anything but going up in that sort of environment. That'll bring everything up along with it. So the S&P finishing around 4130 for the week. That's up 1.4%. We're going to look at a chart of the S&P here in a few moments, and you'll see why we are nearing a key level of resistance. I think is going to be vital going into next week. Mid caps and small caps both up a little bit, but not as much as the major S&P. And the NASDAQ outperformed the S&P with the NASDAQ composite up almost 2%. The VIX continuing to drop. So that's one of those key things to look at. Or I have a chart, which I don't know if we'll have time to get to, looking at high yield corporate spreads, looking at the VIX. And both of those have been coming off. Spreads have been tightening. The VIX has been coming off, which tends to mean stocks are rallying. And that's basically what we've been seeing. Interest rates coming off today, the dollar as well. And I would say out of everything, that chart of the dollar may end up being super important. The raging uptrend in the dollar has not just held gold back, but it's had a lot of things back, right? Sort of the wrecking ball for risk assets, as we've talked about on the show. The dollar reverting back to the downside gives room for some of these things like stocks and cryptos and others to do much, much better. Gold and silver both having a decent day, along with most of the rest of the commodity complex. The energy sector blew out everything else today. Finally, Crypto's a bit mixed today. You have Bitcoin and Ether both up, but they've really been choppy for the last 24 hours or so. So no real great signal here. So interesting to see stocks continuing to rage higher. Cryptocurrency is actually stabilizing. Now, obviously, they've had a really good run, had a really good week, of course, after weeks and weeks of challenged tapes. So certainly some potential there. Let's just look briefly at sectors because you don't get that a lot in our Mindful Investor live chart list. Energy number one, up over 4%, followed closely behind by the XLY. Now, remember, the XLY is dominated by Amazon. So Amazon up 10% is going to push the XLY up to the upside. That energy leadership thing is an important trend. We're gonna hit on that here in a few moments. Industrials number three, up 2%. On the downside, it's defensive stuff like consumer staples and healthcare, followed by communication services. And if you look at the 8 phenomena stocks, that FANG plus a couple others, you can see that after Amazon up 10%, Apple up 3%, we start to get into the others. And two of these names, both within communication services, Netflix and Meta, having the worst performance day out of the group and probably the worst week out of that basket of stocks. The tech and consumer stuff is doing much, much better than the communications names. Let's finish off our recap here looking at the Mindful Investor Live chart list. As a reminder, this is a list of charts that I keep updated. Go to my blog on StockCharts.com, which is called The Mindful Investor, if you want to access this list from your own account. Here's where things played out through the remainder of this, or through the course of this week. My market trend model is driven by weekly data, weekly closing data. So as of Friday's close, we can lock in the updated terms. The short-term model remains bullish. It actually turned bullish last week after about 4 weeks of chopping around the zero line. So clearly confirming a short-term bullish tape. My medium-term model, not quite getting to bullish, but really, really close. And as this, I feel like if we had a 6-day week, it probably would trigger tomorrow, given the strength that we've seen with all of these earnings. So the weekend is going to be pivotal to see what happens when we reload next week. Do we continue enough to push the medium-term trend model for me positive or not? Long-term trend model still negative, and that's about what this feels like. Short-term is strong. We are right at the point where I could start making a legitimate argument that the medium-term trend is now turning positive. The last time we had this argument, but with the chart, was basically in March, right? Which is a very similar tape. A rally, my medium-term trend model turned just slightly bullish for about a week or two before turning back negative. And that's my concern with what we've seen now, just as a precursor to the next chart we're going to look at. Have we gone so far that we start to stall out? Here's the thing. The S&P has appreciated from 3650 in mid-June, about 6 weeks later, to finish the week today around 4130. That's a decent reversal. It's almost a 500-point swing back to the upside. Here's the challenge. The last time we had a similar feel, which was the market basically in a confirmed downtrend making lower lows, coming off the lower low, we make a new swing high, and then we break to the upside. We got right to the previous swing high from February. This is around 4,600 for 1 day only. We had this brilliant close pushing above that level. It felt like 5,000 was just, you could feel it. And then we immediately rolled back down, and everyone recognized, well, the bullishness here was extreme. Remember how optimistic everything felt here. It was like, all right, that was just a brief couple months. Now we're going to rip to the upside. But then all of the reality of what's going on here, higher rates, the Fed with their much less accommodative positioning and policy changes, the prospect of a stronger dollar and higher interest rates, what that means for growth stocks, all of that just killed the market for the next couple months. Now we have a very similar pattern. The market has rallied off of a new low and then a subsequent higher low, similar to what we saw in end of February, early March, and then breaking to the upside, breaking above the 50-day moving average, which is a nice pattern as well. Just like we saw in late March, we are at that similar sort of feel as we get to that 4150, 4200 level. I think this is the chart to pay attention to. I am super impressed by the strength, not just on the S&P, but on a lot of individual names. As we go through the course of the show, I'll try to hit on some of those that I think are most important, but it's worth noting that we on some of these particular names, we're showing a decent amount of strength, but it's all about getting through that level. If we would get above 4,200, I can't imagine someone would be able to remain bearish given that fact, right? Not only have we had a bear market rally type of feel, we've had enough momentum to get above a huge resistance level. That would be enough to convince me for sure. But until we do that, I still have to feel that this looks a lot like the March rally. And that felt very optimistic right at the end of that too. Just to finish off, I wrote an article here briefly for the Mindful Investor, my blog that I mentioned. Go to the articles page on StockCharts.com. You can read that article just posted about an hour ago, where we talked about the cumulative advanced decline line and also two other measures of breadth, where they're at right now, what that means about the potential for having further upside from here for stocks in general. So we don't have time to go through much more in terms of breadth, but I'd encourage you to go to the articles page and read my latest post looking at breadth conditions. Let's take a quick commercial break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. It's great to have you join us every weekday after the close. It is so much fun to do the show. We have a great team at StockCharts TV, our producer, Gretchen, our technical director, Zach, Rachel, who lines up all of our guests, and many, many more doing graphics and all the behind-the-scenes work to make the show successful and to bring great commentary in front of you every weekday. As a reminder, we welcome your questions. We're going to do a mailbag segment here in a few moments, and we'd love to answer one of your questions live on the air. Our email is the best way to get your questions in front of us. That's the final bar at StockCharts.com. And as a reminder, include a screenshot of the chart you're looking at if you could, or a permalink. And if you're looking at the charts on StockCharts just below the Sharp Charts platform or in ACP, you have the ability to send a link. And that hyperlink will allow me to see a live version of the chart you're asking about. So email us your questions, or on Twitter at FinalBarSCTV, or on YouTube. Just check out the StockCharts YouTube channel and make sure you subscribe to that channel while you're there. Also, go to StockChartsTV.com. I mentioned all the great special programming we have next week. The Pitch, Larry Williams' latest market outlook. We had Martin Pring giving a mid-year market outlook a couple weeks ago. We have our latest episode of The Pitch coming up next week. So much great content, and it's all for free at StockChartsTV.com, or on your mobile device. Just search for StockCharts TV on demand. Let's continue on with today's show. Opening the Final Bar mailbag. Keep the great questions coming, and let's get to question number one. Oh, actually, sorry. We do need to power up. Well, how could I forget this? This is my favorite part, where we actually upgrade our use of the StockCharts platform. Why skip this, Keller? All right, here we go. We're looking at the StockCharts dashboard. In the upper right corner, you have these gears. I would encourage you, StockCharts members, to click on the gears because you see a new option. We just had our Bainbridge release, named after Bainbridge Island in the Puget Sound, and the Bainbridge release included a number of really cool features over the next couple of weeks. I'll be highlighting one of those every Friday just to help you understand how to use them. There's this thing called chart panels. Here's what we decided. We decided we wanted you to be able to embed some of your favorite charts directly into your dashboard. Your dashboard should be sort of your homepage with all the stuff that you think is important. And I've customized mine quite a bit to show sector summaries, to show predefined alerts, market movers, the scooter rankings. You can change each of those. I also include two of my stock lists, my chart lists that I like to follow. Dow Industries, so I can see which industries are working or not working on a particular day. And I also have these 8 mega cap tech and consumer and communications names that I want to follow as well. I also now can add charts. And so what I would encourage you to do is add that. And if you click on the little gear, you can change what chart you're looking at. What I would start with is bring up some of the charts in your chart list. So for example, I have this one, which is a big, full-size, beautiful, high-resolution chart. But here's the problem. If I add another chart panel, which I can add a bunch of them, if I add another one, all of a sudden my brilliant chart is a little smaller because it has to shrink down the graphic. So here's my pro tip for you, having used this feature here for a couple of weeks. I would create a separate chart list called Dashboard Chart Panels, and then fix some charts in there that have the right look in terms, because you can customize the exact pixel size of your charts. That's how cool StockCharts is. And so if you set up the correct size of charts, you can make these look brilliantly crystal clear and allow you to reflect on the most important charts in your toolkit while you're looking at what the market is doing. So that is a new upgrade to the platform just in the last week, called the chart panels on your dashboard. Click on the gears in the upper right corner. Now we are able to open up the Final Bar mailbag. Let's answer some of your questions here. Here is question number one. Can you tell me whether the swing highs or lows and the next support and resistance levels are the same or different in different timeframes? For example, daily versus weekly versus monthly. That's a really, really good question. And, we often, for the sake of brevity, only focus on one particular time frame. And that's just due to necessity, right? And we can look at any of these charts. The chart of Apple, for example, is a good example. And you can see the short-term, rally, the Apple getting above 150, getting above the 200-day moving average. That's pretty interesting, certainly. And this is a stock that had been making a new high at the end of last year, retested it in March, but then making a new low down to 130. So on the daily chart, where we're at is we start here and we look to the left. That's where we recognize 150 as resistance, 130, 135 as support. Further up, maybe 165 as a resistance, then probably 180 as those previous levels, right? Support and resistance is all about looking at where we're at now relative to where we've been and focusing on some of those key levels. Here's the thing. If we look at the same thing on a weekly chart, though, things look a little bit different because now that last year or two is just compressed into this side of it. And now we're looking at longer term trends. So when I'm looking at the weekly chart, I'm probably focusing much more on 130 and 180, right? All those sort of intermediate support and resistance levels are kind of irrelevant now, right? On this time frame, it's all about the big picture high and the big picture low. So on different time frames, I would argue most likely you're going to be talking about different levels. Now, a lot of those could be very similar, right? So on the daily chart, 180 jumped out as a key level of resistance because we're approaching all-time highs. On the weekly chart, that understandably seems important as well. But on the weekly chart, you might find some of these previous support levels that we are nowhere near at the moment. But if we would have some big movement, we can start to see some of those levels. Also, something like the 150-week moving average, which I would never show on a daily chart. Here we can actually look at longer-term moving averages, longer-term measures of trend, and get another sense of where support or resistance may come into play. So I would argue, yes, swing highs and lows, support and resistance levels, even moving averages, they're probably different on different timeframes. And that's why it's so important to look at a chart. Your main chart should be in line with your particular time frame, but also be judging other timeframes and compare those levels across those timeframes. That's where you really get a sense of where we've been and better anticipate where we may be headed. Next question, what's your take on the VIX versus the S&P? That is a fantastic question. And I will show you, if I have time, two charts. I'll start with sort of my main chart of the VIX. As I mentioned many times, I think of volatility in terms of volatility regimes, right? And if you look at the VIX since November of last year, which is when the market last, really topped, although the S&P made another high in January, a lot of things I think topped out in November. That's more of what I think of as the end of that bull market phase. You can see as we entered into this bear market phase, the whole character of the VIX changed, right? The whole range pops higher. So instead of being between 15 and 25, we're now between 20 and 30, 35, probably right on the upper end. So now we are coming off, the VIX is coming lower, which usually happens, right? When the market's rallying, it tends to be a little more orderly, a little less uncertain. And so volatility tends to be a little lower. We don't panic buy as much as we panic sell. And panic is what this is basically charting uncertainty, charting volatility, right? So now the VIX is getting back near 20. And if you look back at the March high, again, I'm concerned by how many data points are comparing right now to what we saw in March, right? We had this big rally that drew a lot of people in for understandable reasons. We stalled out right at the previous high. I'm concerned that we are once again approaching kind of the same thing that we saw then. They're about 6 weeks apart. It's kind of right where we're at here as well. The similarities are staggering. A lot of the breadth indicators look very similar. And now the VIX is at a very similar level. The last two times it was down at 20 was here at the March high and here at the February high. So if we are still in this broader bear market phase, we are nearing the point where most likely you see a pretty significant top and then the downtrend would resume. What would tell me that this is something different? Very simply, the VIX gets below 20 and stays there. That would tell me we're more in a orderly bull market type of phase. We're more in a recovery mode where people are just accumulating shares and more buying into the optimism. So I think the VIX right now versus the S&P, super important chart to watch. And that's why I think it's a key one. Great question. Next one here we have time for. How do I scan through a list of stocks in a chart list and see their sector, industry, market cap, PE, and upcoming next earnings? Bonus round, what if I want to see year-to-date performance? So what's cool is the chart list feature allows you to do all of those things, and we've been adding more and more information on there. So if I look at I have one with just the Dow stocks. That's a good kind of manageable list. If you bring up a list and look at the summary tab, our table may look a little different because you have this columns button where you can add things like sector, industry, where a moving averages, the RSI, the ATR, last earnings, next earnings, PE. You can go absolutely nutty adding as much of these as you want. It's just going to keep adding more and more data onto your screen. What's cool about it is then you can start to sort by all of those different columns. So what this now allows us to do is say, all right, let me sort by their next earnings, and I can see from my list of stocks, when are these companies that I'm following starting to report? So out of the Dow, I can see we had Chevron, P&G today. Now coming up next week, we've got Caterpillar, Amgen, a little lighter on earnings in the Dow names. We had a lot obviously rolling off here recently with some mega cap stocks. But for a list of names, when are they going to report? What's the momentum characteristics? What's the scooter ranking, the sector and industry? All that is possible. For performance, we have another listing. It's outside of the summary tab. Actually, go down to the performance report. You can add different performance timeframes, and you can sort the list on any of these column headings that you click in on. Pro tip on this one is add another ticker up here where it says compare to. So if I do compare to the S&P, I'm now doing these as year-to-date performance relative to a particular symbol. If I take that out, it's just going to do the simple performance. I usually have this set to do the SPY. You can see it adds the relative here. And now I'm looking at relative returns over those different timeframes. What a fantastic, powerful way of making sense of things. Final question, does your scooter ranking take fundamentals like the PE ratio into account for a stock like a VALE? And the answer is no. So our scooter rankings, our StockCharts technical ranking is based on pure price momentum and has three different timeframes: long-term, medium-term, short-term. It actually excludes fundamental information on purpose. This is meant to be a pure read on technical information, right, on price data. A couple things I would tell you about that. If you want to know more about our scooter rankings, hit the little magnifying glass, type SCTR, and you'll get some articles that explain. We actually show you the methodology and explain how we would recommend you think about it, how you can incorporate it into your process. There are other tools like Chaikin's Power Gauge comes to mind that has both a technical and a fundamental component. So if you want to see a good example of a model that combines both of those in a meaningful way, go to our ACP plugin store and look at Mark Chaikin's Chaikin Power Gauge plugin. It does a great job of combining those. Really good questions, you guys, as always, and please keep them coming. We need to wrap this show, and let's go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We're looking at Apple, and we look at the chart of Apple. It is a breakout, right? And I think there's no denying, regardless of what your overall sense of the market is, and I have absolutely been bearish for pretty much all of 2022. I am struggling in this environment to remain long-term bearish, but at this point, I still am, because this rally seems like a classic summer rally, which we've seen the last couple of years. The rally has taken us to a key level of resistance. The breadth conditions have taken us to exactly where we were in March, which was the last time we had a huge bear market rally off of a new low. We stalled out at the previous resistance level and we rolled over. What would tell me this is different is if we don't stall out, which is why that 4150 to 4200 level on the S&P is so vital. But every chart like this that I see, it makes me less confident in talking about a long-term bullish market, because Apple's back above its 200-day moving average for the first time since early May. It's made a new swing high. So 150, 155 was that resistance level. It blew right through it, and now it's breaking higher. So by this classic sort of trend following technique, that opens the way to go back to 180, to go back to the new highs. Apple's overbought right now, which is why I think this is a really key chart to watch. As these stocks that have had a good run become overbought, is that the sign of upside exhaustion or not? Chart number 2, LKQ. My guest yesterday, Ms. Schneider, we're talking about retail stocks. And one of the groups that I've been talking about a lot with my market misbehavior premium members, auto parts. And some of these stocks have had really good runs with strong moves to the upside. GPC is probably a good example of a stock making a new 52-week high in that group. LKQ is one that's interesting to me because, similar to Apple, breaking above the 200-day, in this case, retesting it, and then continuing higher. Finally, XLE Energy had a strong day back above the 50-day moving average, again showing strength. These sectors, these stocks, able to hold above their June highs is key for the bullish thesis. Folks, that's a wrap for this week. I'll run through a lot of charts in 30 minutes. Thanks so much for watching us. Have a fantastic weekend, and we will see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.